Okay, hello and welcome to our latest BNZ Agribusiness Economic Update. My name is Geoff Rawcliffe and I'm a corporate agribusiness partner based in the Waikato. Our last update was back in November, and as always, plenty has been happening since then to update our valued clients on. As per our normal format, I have Doug Steele with us today, Senior Agribusiness Economist with the BNZ, and I'll be firing a series of questions at him, which we think are relevant at the moment to update you on. So the session will take about 20 minutes, so grab a cuppa, sit back and enjoy the update. I thought I'd start on a real positive note today, Doug. World food prices are quoted as being the highest since 2014. This is fantastic for New Zealand and in particular the agri sector. What's driving this and how long can these levels be sustained?
Yeah, g'day Geoff, and it's good to chat again and welcome everybody. First thing I should probably say is that this update isn't advice, it's general information, as we need to say these days. But yeah, food prices, what a great way to start. Internationally, as you say, up to 2014 levels, or we haven't seen these levels since then. A big increase from the lows that we saw last year, and I think food prices in total, if you look at the UN price index, what is it, up 10% on a year ago and up nearly a quarter from the lows that we hit last year. The drivers, it's always hard to know specifically, and every product will have its own idiosyncrasies, if you like, but I think generally speaking, demand has been quite strong, especially out of China, and a lot better elsewhere compared to expectations. I think going into the pandemic, there was forecasts that there was going to be a much reduced pricing level for most commodities, including food. That just hasn't happened, and sure, there's been a big change in the consumption patterns and where people have consumed food, but I guess, people have to eat, as they say, and the demand for food, and particularly quality stuff like ours, that has come through and prices have held up. At the same time, we've had a lot of other factors. There has been supply side tightness in some areas, particularly grain. If you look at the stock to use ratio in global grain markets, it's at a 7-year low. So there is a bit of tightness in some of those markets. And also the logistical and supply side issues that we've seen around shipping lines and the like, that hasn't helped allocation of resource across the globe, if you like, and certainly helped squeeze our prices up here and there as well. I think one of the big drivers underneath it all has been enormous monetary policy support to help the world economy out in general, and a general weakening in the US dollar. A lot of commodities, a lot of food prices are priced in wholesale markets in the US currency. So when that goes down, it tends to be an uplifting factor to those prices. And also just general level of very low interest rates and printing of money around the world. It's gone into various places, and one of those is into commodities, which has benefited, if you like, in terms of the price gains that we've seen. So where to from here? I think optimism's growing around the world, and if you can take New Zealand example in COVID and the bounce out of lockdown, we still have a lot of places around the world in lockdown, but if New Zealand is an example of what happens when you release people from the shackles, we come out and spent like crazy, and so you could sort of build a case that later in the year, hopefully, when the world is, those restrictions are relaxed, maybe we do get quite a bounce in activity in demand back to food service and the like. So hopefully this food price gain does have some legs.
Thank you, Doug. Yeah, it's certainly a great news story at the moment. So I suppose just sticking with, I suppose, the main agri commodities, are there any sectors worth commenting on specifically, and any further upside into some likes of dairy, which is obviously going very well, or others that aren't faring as well?
Yeah, I mean, as you say, every product is very different. It's hard to sort of cover them all. We can't do that in a few minutes, but dairy is obviously really important for New Zealand and has been one of the stars of the show. You look at the GDT auctions and they've been exceptionally strong for a few months now. I think GDT prices at the last event, at least in the mid-February one, was up around 20% on a year ago. You know, that's a pretty solid increase, and from good levels. So we're seeing, you know, the likes of whole milk powder, you know, well north of what might be normal at $3,000 a tonne, and we're well into the 3.6, 3.7 area. That obviously translates into good milk prices at home. So, you know, we're looking at on the board we have $7.40 for the current season. We'll see where we land. You know, there's a whole lot that goes into milk, making up milk price precisely, but certainly those international markets are pretty favourable. And I think, you know, looking into next season is really where the crystal ball comes in. They haven't been all that good over the years, and I think farmers know more than anyone that it is very difficult to forecast milk price. But for what it's worth, we do have $7 on the board for the 21-22 season. Obviously watching those auctions to see if the current strength in prices can be maintained to justify that. If anything, you know, there's maybe even some upside risk to that $7 mark, but the reason we're not pushing it is we're very conscious of the strengthening Kiwi dollar, which will just suppress some of those some of that buoyancy that we're seeing in international markets. But it's not only dairy. There are certainly other products that are going very well. Kiwi fruit springs to mind. I see Zespri lifting their latest forecast a little bit more. Green variety now up to a record. You know, we're at $7.27, I think it is a tray. You know, that's right up there, and gold pushing further above $12 a tray. You know, very good returns for that sector, and volume still coming on stream in the gold space. Yeah, other markets, lamb, you know, back a little bit from you know the highs we saw a year or so ago, but still troughing out, it seems, at this season at around $6.50 a kg. I think that's a bit better than some people were thinking. For the season average around $7, that's still pretty good returns. Beef, a little bit similar to lamb, probably a fraction more on the weaker side, but still a pretty good level overall. And I guess the lack of supply out of Australia in the beef markets is certainly a support to pricing. On the demand side in beef, it's still a contest, I guess, between the US consumer and the Chinese consumer, which has pulled back a little bit with the African swine fever in China. You're seeing a rebuild in the pig herd in China, and that has probably tempered demand a little bit for those alternative proteins, and beef being one of them. So, you know, a lot of movements within the individual industries, and sure, some aren't going so well. Venison is still one that is struggling with the closure of food service around the world in key markets, particularly Germany. So, you know, it doesn't mean everyone's going well for sure, but the general picture around food pricing in international markets is positive.
Yeah, great. Thank you, Doug. There's certainly some positive stuff there. I thought I might move on to interest rates, which are obviously extremely low presently, which is fantastic for borrowers. But certainly noticed over the last little while that the longer end of the curve has certainly started creeping up, which is one to watch. What are your thoughts on where this is heading, and you know, is it a good time for those that are heavily floating to look at you know, some fixing options?
Yeah, very interesting time to be talking about interest rates. It's there is a whole lot going on in wholesale markets. I guess if you look at what the Reserve Bank said in their late February monetary policy statement, they essentially kept their policy rates unchanged. So the official cash rate of 0.25 and their various other programs unchanged. And it's easy to think, oh, well, there's nothing to see here, especially when the Reserve Bank is saying that they're likely to keep that cash rate steady for a considerable or a prolonged period of time. At the same time, there is a lot going on in the details, especially in wholesale markets. So we're seeing quite a sharp rise in interest rates offshore in the US or in Europe, especially at that long end, the 10-year part of the curve, but it does flow into rates that borrowers will be facing in New Zealand into the likes of the 3, 4, 5-year part of the interest rate curve. So even though the cash rate might be staying put for some time yet, markets will will always look to see where the next move is. And now the discussion around negative rates from last year is seemingly off the table, and I think that's right. Markets are starting to think when's the next hike. And so you're seeing the likes of 3 and 4, 5-year rates push higher on the expectation that the cash rate might be lifting sometime next year. It does still feel a long way away, and there's a lot of things that can happen between now and then. But I think you look at something like, just to put a number on it, if you look at 10-year rates in New Zealand and the wholesale markets, they've lifted 100 basis points in the last couple of months. That's an enormous move. Borrowers at the retail space don't borrow for 10 years, but it does have an influence on the likes of 5-year or 4-year. It all sort of floats down the interest rate curve, if you like. I guess the main point that I'd like to make in terms of interest rates, that even though the cash rate is steady and likely to stay there for some time yet, there is big moves in wholesale. So it would very much pay to talk to your BNZ Agri manager and find the latest and get the latest information to base your decisions on. It's not a simple case of just looking at the OCR and saying it's not changing for a while yet.
Yeah, it's often the way, isn't it? You sort of leave it until floating rates look like they're going to move, and the long end of the curve's already got well ahead of you. So it's certainly something to keep abreast of, isn't it? Thought you touched briefly on exchange rate before, Doug, and that it's obviously strengthened further, and that offsets some of the gains around overseas commodity prices. But what's your thoughts on where it's at and potentially where to from here?
Yeah, I see the currency as quite reflective of what's happening internationally. So there is a lot of optimism that the world is getting through this COVID thing. We're by no means out of it, but the prospect of better growth ahead as the social restrictions are relaxed. That's seen the likes of equity markets punch quite a lot higher over the last several months, as part of why commodity prices are higher, as I was talking about before. And as part of that, if commodity prices are strengthening internationally, then that means New Zealand's going to go pretty good. That means the New Zealand dollar tends to lift, and that's what we've seen. It's up, in the low 70s now against the US, where it was, well back into the 60s if you go back a few months. So I think that's the driver of it. I guess the question now is where next. Our general view is that the New Zealand dollar, especially against the US dollar, continues to track higher. That's on the idea that the world will carry on improving, the vaccine rollout carries on, and we get social restrictions relaxed. If that's the case and activity does pick up globally, commodity prices should stay well supported, and you should see the Kiwi dollar being reflecting that as well. So for what it's worth, we do have about 76 pegged for the end of the year against the US dollar. It's dependent on a whole lot of things, but it gives you the idea that the general trend we see for the Kiwi is still upwards. At the same time, near term, I'd be a little more cautious. Given this very big rise in longer term interest rates that we're seeing overseas, there is a prospect that those start tempering the enthusiasm that people have for this world growth outlook ahead. Maybe they're getting a little bit ahead of themselves, pricing it a bit too early. If that's the case, and the likes of equity markets come back a bit on the back of higher interest rates, then if that's the case, you'd probably see the Kiwi dollar a bit more choppy in the near term. But broadly speaking, it feels like the world economy is turning the corner. It's on the right track. It will take time to get through this for sure, but if that optimism is warranted and we do get higher activity, you'd expect the Kiwi to track higher. But I would say there's a lot of US dollar weakness in that story. So it's sort of the flip side of the Kiwi strength. If you look at the New Zealand dollar against other currencies, say the British pound, for example, we haven't been strengthening because the British pound has been lifting itself post-Brexit. They've got some sort of deal now, and the UK is rolling out the vaccine a lot quicker than many other countries. So optimism there, even though it's from a very low base, is picking up, and the British pound has sort of gone with the Kiwi. So we're still around that low 50 mark, which is helpful for exporters going into that market.
Great, I appreciate the view there, Doug. Always a tricky one. Keen to touch on Reserve Bank intervention. Now, it was interesting to see the government mandating the Reserve Bank to keep the housing market under control, which is a bit of a shift there, and obviously a reason behind that. Keen for your thoughts on this, and also obviously proposed capital changes that were signalled for banks and were supposed to be in place prior to now, but have been delayed due to COVID. What are your thoughts on how this sort of will play out, and any impact around the availability and cost of capital for different borrowers in different sectors?
Yeah, good question. It's you can't really have an economic discussion at the moment without talking about house prices, it seems, and here we are. But yeah, so it is interesting that the government has asked the Reserve Bank to look at house prices. I would just caution that I think that some of the media have got the wrong end of the stick here. The government hasn't directed the Reserve Bank to target house prices as such. In terms of its monetary policy remit, the Reserve Bank's targets have not changed, that they are still focused on CPI inflation and maximum sustainable employment. What has changed is that the Reserve Bank now has to assess what the implications of their decisions are on housing and the government's target to having more sustainable house prices. So you make the monetary policy decision, and then you just assess what the impact would be on housing and sort of communicate that. That doesn't mean that it will necessarily influence the decision, and I actually think that change won't really have a material impact on the outlook for interest rates. It will maybe change the way it's being communicated, that yes, this will be the implication for house prices, but it shouldn't influence the decision itself. What may have a bit more, there's another change as well that occurred there, which is in the financial stability space. So in that area, the Reserve Bank now have to have regard to house prices when setting its financial stability tools. So if you think of like the LVR and those sorts of instruments, that's more likely to have some influence on those decisions given the government's directive. But in terms of monetary policy and interest rates, not so much, I don't think. In terms of the bank capital changes, yeah, that's still very much lurking in the background. It hasn't gone away. It has been delayed. I think that the timetable for that now is July 2022, which is still some time away for sure. But banks, you can't just go up to that day and suddenly change over if it's a balance sheet change to be made. So banks will be thinking about that well ahead of time. It will have an influence on the cost and supply of capital. I think it's one of many things that are changing and will change between now and then. And yet another reason to be talking to your BNZ Agri manager and just seeing what the lay of the land is as we sit today, and so you can be completely informed and make the right decision for the individual business concerned.
Yeah, certainly, and in that aspect, there's certainly a lot of cash, and I suppose in the agri sector too, there's a lot of very profitable businesses at the moment that are actually paying back quite a bit of debt. So availability of capital at the moment is certainly not an issue at all. So, hey, I thought, Doug, I'd touch on COVID as well. Obviously, vaccines are being rolled out around the world, and the world seems to, as you've touched on, be coping very well. But is the worst of it actually over? It kind of feels sometimes like we're living in a false sense of reality. Are there still risks out there that when some of these stimulus packages are unwound, that there could still be a bit of hurt to come?
Yeah, I mean, it's quite hard to get a perspective on what's happening in the globe when you're sitting in New Zealand. I think we are very lucky to be here and facing the conditions that we have at home. It's clearly not over yet. There is still a long way to go, but if I could phrase it, that I think the light at the end of the tunnel is getting a little bit brighter. The vaccine rollout, if you go back 3 months, we didn't even know if we were going to have a vaccine or if it was going to work, if it was going to work against the new variants and those sorts of things. We've come a long way in 3 or 4 months, and we now have multiple vaccines. They are working. It's being rolled out. I think now a quarter of Americans have got their first dose. More than a quarter of people in the UK have their first dose. It is very much part of why we're seeing the markets move the way they are in terms of pricing in possibility of higher interest rates. It's on the back of the idea that people are going to be allowed out again, and there's going to be a whole big pickup in activity. And as I mentioned before, I think, if New Zealand's a bellwether of what could happen internationally, if we were locked up for 6 or 7 weeks and we come out and had a bit of a spending frenzy, imagine the world that's been locked up for a year and they come out with a big stimulus package as well. In the US, they're looking at $1.9 trillion to juice into the system. While we have to pay for this at some point, I think in the current circumstances, it's still about adding more rather than taking it away at this point. And that includes ongoing support from the monetary authorities. Central banks are still very keen to be making sure that the markets are not trying to get too far ahead of this recovery that people are hoping for. So, we're not out of it, Geoff, but at least that light might be getting a little bit brighter, that we're getting nearer the end.
No, it's going to be fantastic to see how it all pans out, and the car salesmen and the DIY guys might need to be ready for the onslaught. So thank you, Doug. We might wrap it up there in the essence of time. I think we've hit about 20 minutes. So thank you for listening in today. We hope it was a useful update to help you stay informed, and particularly with any decision making you might have on the table at the moment. The agri sector's certainly in a great space at the moment. Confidence levels are up, and we're certainly at the BNZ seeing an uplift of inquiries for projects of right across the spectrum, which is great. There's only so much, obviously, Doug can cover in 20 minutes. So if you're after more detail, you can go to the BNZ website and search market research, and you'll be able to find some detailed publications there from Doug and some of our other researchers. So thank you very much for tuning in, and thanks again to Doug for taking the time to do this update. It's again very much appreciated.
Thanks very much, Geoff. It was always a pleasure, and hopefully enough information there to provoke a bit of thought, if nothing else. Cheers.
Cheers.